A great place to start when searching for potentially undervalued stocks is to look for negative share price performance, and in this video we'll be talking about 4 dividend stocks who've just been plummeting in share price and look like prime pickups as we head into the month of April. But before we get to those, in case you're new to the channel, my name is Ryan Williams, and here we strictly talk about dividend stocks and how you can invest in them to create passive income and reach financial freedom. So if you love dividend stocks and if you're on a mission to retire early, then hit that subscribe button. I'd love to stay in touch as we both continue to grow our portfolios and collect that cash flow. Also, leave me a comment below and let me know which dividend stocks you have your eye on. I'd be curious to hear what you think is looking good. Anyway, getting into the first stock, guys, we are talking about Lowe's, who is one of my favorite dividend kings, and they've seen a dip in share price recently that is presenting what I think is a pretty good buying opportunity. And as you can see, in the last month, they are down just over 7%, which officially brings them to a double-digit loss in the last year, where they are down about 11%. Now, over here on the valuation page, Seeking Alpha is giving them an overall grade of a D, but I personally think they deserve a little bit more credit than that. Looking at their forward PE ratio, this is sitting at 13.8, which in its own right is really not too bad, and this is also about 23% lower than their 5-year average PE ratio. Furthermore, if we scroll down, taking a look at their forward price to cash flow, this is almost in the single digits. It's looking pretty good, and this is also 27.5% lower than their 5-year average price to cash flow. Now, while the share price for Lowe's has come down and the valuation metrics are looking more attractive than they have across these last 5 years, that's pushed the dividend yield up to a point quite a bit above its 5-year average. At this point in time, Lowe's has a forward dividend yield of about 2.2%, which is pretty average. But look, guys, this is about 24.6 higher than its 5-year average dividend yield, so you're able to get a bit higher cash flow return buying Lowe's today than you otherwise would have been able to across these last 5 years. Furthermore, the rest of the dividend stats are looking fantastic as well. Their payout ratio is sitting very low, just under 30%, and that 5-year growth rate couldn't be higher, guys, 20.11%. That is off the charts. And like I said earlier, Lowe's is a dividend king with 59 years of consecutive dividend growth. You gotta love that. And with this company, I'm actually putting my money where my mouth is. I actually bought some more Lowe's earlier this week, as it is officially under my average cost per share, and I'll continue to do so while this is the case. All right, now moving on to stock number 2, we've got Bank of America, who, as I'm sure you can imagine, has seen quite a dip in the last month, guys. They are down 17.5%. That is pretty ridiculous. And in the last year, they are down a whopping 34.5%. Quite a big drop for Bank of America. Now, over here on the valuation page, with this drop in share price, Bank of America is officially trading under their book value with a forward price to book of 0.82, which is about 28% lower than the 5-year average price to book. So there's a bit of a discount there. And just like with Lowe's, this dividend yield is much higher than the 5-year average, currently sitting at 3.24%. This is 44% above where the dividend yield usually sits on average, 2.25%. So a bit more of a cash flow return buying into Bank of America at current prices. And once again, guys, the rest of the dividend stats are looking great. A payout ratio that's also below 30%, nice and low there, with the 5-year growth rate sitting right near 15%. So you're getting some nice dividend growth there, and 9 years of consecutive dividend growth. That's not a bad track record. And now, guys, moving on to stock number 3, we are talking about Nexstar Media Group, which is America's largest local TV and media company with 200 broadcast stations all across the country. And through their networks, they're able to reach more than 68% of US households, which is quite a big number. And I actually found out about this company very recently through my main man, Russ, who thinks you will regret not investing in Nexstar Media because they are such a force in digital and mobile media. And they look to be at quite a bit of a discount as well. In the last month, they are down nearly 12%, which puts them at a loss in the last year, also double digits, just about 10%. And despite this poor share price performance, especially in the last month, Nexstar Media still looks to be firing on all cylinders. Taking a quick look at some of their financial stats, first and foremost, the revenue growth is off the charts, and over the last 5 years has grown by an average of 21% per year. Also, their earnings and free cash flow growth is looking rock solid, and in the last 5 years has grown on average by 47% and 15% respectively. And look at that dividend growth chart, guys. That is what we like to see. And just like the first two companies, Nexstar Media's dividend yield is quite a bit higher than the 5-year average, currently sitting at 3.37%, which is 62.5% above where it has historically sat over the last 5 years. And the rest of the dividend stats are just, oh my gosh, guys, unbelievable. Super low payout ratio, just under 15%. I don't know if I've ever seen a payout ratio that low. And I thought Lowe's had a high 5-year growth rate at just about 20%, but this is taking the cake, guys. 26%, and they've been growing this dividend for the last 9 straight years. And with that, guys, that brings us to stock number 4. We're talking about NetApp, which is a data management company that helps their customers create what they call an evolved cloud experience, which in their words means going from accidentally using multiple clouds to purposefully and strategically leveraging them and ensuring they are efficient, secure, and continually optimized. In a nutshell, this evolved cloud experience exists to help their customers, many of which are small to medium-sized businesses, simplify the management of of their data and storage in the cloud. And guys, this stock has really dropped in share price lately. In the last month, they're down 6.3%, but over the last year, they are down nearly 30%. Look at that drop. And over on the valuation page, the metrics are looking pretty good. Their forward PE ratio is sitting at 11.3, which is nearly 25% lower than their 5-year average PE ratio. And if we scroll down, taking a look at the forward price to cash flow, this is nice and low in the single digits, 9.74, which is about 19.3% lower than the 5-year average. So that's looking good too. And once again, taking a quick look at some of their financial stats, the revenue growth is looking steady, and over the last 5 years has grown by an average of about 7% per year. And their earnings per share has really jumped up over the last few years, and the free cash flow growth is looking steady with respective 5-year average growth rates of 291% and 12.5%. And because this company has come down so much in share price, the forward dividend yield is sitting about 14% higher than the 5-year average, right at about 3.3%. Not too shabby. And everything else is looking good too, guys. Nice and low payout ratio. I don't think we've seen a payout ratio that's actually above 40% today, which is really cool. And once again, their 5-year growth rate is pretty amazing. We got another 20% 5-year CAGR here with 9 years of consecutive dividend growth. I love to see it. And so those were the 4 main stocks that I wanted to dive a little bit deeper into today. But guys, there are still so many other stocks that you need to keep your eye on as we head into April. The first one you need to keep your eye on is Kilroy Realty Corporation, KRC. You guys know I was going to bring this one up. They are down 19.26% just in the last 30 days, which brings them to a loss in the last year over 61%. That's unbelievable. Next up, we've got 3M, who's down about 7.5% in the last month and is getting pretty close to being in the double-digit share price, almost touching below $100 per share. And in the last year, 3M is down 32.1%, so a pretty big drop there too. And then next up, guys, you know we have to bring this one up. Medical Properties Trust, MPW. And I know MPW is a pretty polarizing stock right now. There's 2 different camps of people. One group thinks it's a big yield trap, the dividend's gonna get cut, it's a completely worthless company. And then on the other hand, there's people who think it's still a pretty good investment. And at the very least, this 15.4% dividend yield is definitely enticing. But at any rate, MPW is down 30.5% just in the last 30 days. You don't see that too often, guys. That's pretty unbelievable. And then in the last year, they are down nearly 65%. Wow. But anyway, continuing on, next up, we've got Allstate, who's also seen a really big drop in the last 30 days, down about 18.5%, which brings them to a loss in the last year, just about 24%. And then next up, we've got Stanley Black & Decker, who's been beaten down for quite a while, and they just keep getting lower and lower. In the last month, they're down 11.3%, which brings them to a loss in the last year, near 46%. Continuing on, the next company to keep your eye on is Whirlpool, who's also been beaten down for quite a while. And in the last month, they are down nearly 10%, which brings them to a loss in the last year, about 30%. This company just cannot catch a break. And then guys, next up, we've got Pfizer, who's really not down too much in the last month, only about 2.5%. But in the last year, they are down 24.5% and is sitting pretty close to their 52-week low. But anyway, moving on, guys, another one to keep your eye on is Tyson Foods, who we really haven't talked about for a while, probably a couple months on this channel, but nonetheless, they are still at a big discount, down 5.3% just in the last 30 days, which brings them to a loss in the last year, about 33%, and they're also sitting right at their 52-week low. And then the second to last company to keep your eye on is the monthly dividend company, Realty Income, who is down 7.2% in the last month and is down 11.66% in the last year. And I know for a lot of you guys, once Realty Income gets below that like $60 mark, that's when a lot of you guys start buying in, and it's getting pretty dang close to that, less than $1 away, so keep your eye on it. And then last but not least, we've got Johnson & Johnson, who's really also not down too much in the last month, about 2%, and then in the last year, they are down about 13.8%, so that's quite a big drop for this company there. And I think these last 2 companies, Johnson & Johnson and Realty Income, are 2 great additions if you're trying to build the perfect portfolio, which is what I have for you in this video right over here. This 10-stock portfolio is perfect for brand new investors who don't want to go the ETF route, but are still looking to build a well-diversified portfolio with steady, growing dividend income and beats the market, which this portfolio does by quite a bit. So click right over here to check it out, and I'll see you in the next one.